Good to see that we're able to get together after COVID. Hopefully we're after COVID. For those of you not familiar with AGC of America, we're the leading national construction trade association with over 26,000 member companies, 6,500 general contractors, about 9,500 specialty trade contractors, and 10,000 suppliers of equipment, materials, and services like many of your firms. So I'd encourage you to look at agc.org, see where the nearest one of our 89 local and state chapters is, and if you're not a member, at least get in touch with them, see what value there may be in working with them. What I want to talk about today is what's going on with the labor supply in construction, the number one concern for most firms, but also about their costs on both the labor and materials, any remaining supply chain issues, and then where I see different segments of construction headed over the next year or so. By all means, have your questions ready for me. I'd be glad to answer them afterwards, or if there's something that you think deserves clarification while I'm going on, go ahead and make a fuss while I'm talking. Let's start with the employment situation. This graph shows three lines. The green one, these are all year-over-year changes. So the green line is that headline figure you hear about on the first Friday of each month, total non-farm payroll employment. And we got a very pleasant surprise with the September reading that employment had jumped by 336,000 jobs, more than I think any economist, certainly more than I had expected. And the year-over-year increase more than 2%. Well, the Bureau of Labor Statistics also puts out figures on 5 segments of the construction industry. I've consolidated those into 2. The blue line shows the year-over-year change in residential construction. That would be home builders, multifamily, general contractors, specialty contractors working on new homes or additions and renovations. The red line puts together building and specialty trade contractors plus heavy and civil engineering firms. And what you can see at the left side is that in the first months of the pandemic, when the economy really shut down, both types of construction also lost employment at a huge rate. But construction bounced back a little better than the overall economy. As people were able to leave their homes, they rushed out to buy new ones or renovate and add to the ones that they were in. And non-residential projects that had been halted by owners or government order were able to resume. However, then non-residential employment stalled for about a year, finally turned positive in early 2021, and since then, in the last several months, it's actually grown faster than the total economy or than residential. The real surprise to me here is that residential employment is still climbing. Certainly it's not because of more single-family activity. Just this morning we heard that existing home sales had fallen to a 13-year low. New home sales have also tanked. But multifamily projects, according to the census report yesterday morning, for the 4th straight month are running close to record levels in a series that dates back more than 50 years. About 1 million multifamily units are currently under construction. Why? I think the explanation is they can't get the switchgear, the transformers, the elevator or HVAC or door security parts. So crews that would have finished months ago are still employed on those projects. But census figures also show a huge drop, 30% or more, in multifamily permits and starts. So once these projects finally do finish up, then I think we'll see quite a drop-off in residential employment. Here's what's going on state by state. And we'll have the September figures tomorrow morning, along with figures on construction employment in 358 metro areas. AGC will be putting out a press release that ranks all the states by change in employment, and after that, all those metro areas. At any rate, from August of last year to August of this year, 45 states were in the green, that is, an increase in construction employment from a year ago. And this map has been consistently green for several months now. In other words, construction is growing almost everywhere. But that's not the full story. This chart takes a different series from BLS called the Job Openings and Labor Turnover Survey, or JOLTS, my favorite acronym for a government survey. And the blue line shows the number of job openings on the last business day of a month, in this case August, in each year in the 33-year history of this series. The red line shows the number of people hired during the entire month. And so you would expect that there would be a lot more hires over particularly a 31-day month like August than on a single day at the end of the month. And that was true from 2001 until just the last few years. But in the last 3 years, the number of openings has been equal, more or less, to the number of people hired during the entire month. So my takeaway from this is the industry actually wanted to bring on board twice as many people as it was able to hire. Why is it so hard? Well, the unemployment rate in construction has now fallen to below 4%, has been for the last few years. That's also pretty exceptional. Never was below 4% or even down to 4% before 2019. And you would expect when construction projects finish that some workers would be idle for a few months until the next project comes along. But in today's hot construction market, there are so many jobs waiting to be filled that whether you're in construction or any other field, chances are you're employed as soon as you want to be. AGC of America does a survey every summer that we get a lot of detail about companies' hiring situation and their outlook. And this is a survey sponsored by Autodesk. This year we got over 1,400 responses. And if your firm was a construction firm that answered this, thank you very much. It really helps give us a detailed picture. For me, one of the key questions is, did you have a job opening? In particular, we asked separately about craft and salaried workers, an opening for hourly craft workers on July 1st. 85% of the firms said yes. Then we asked, if you had an opening, was it hard to fill? 88% of the firms that had openings for craft workers said yes, it was hard to fill. We drilled down and asked about 21 separate crafts, and for every one of those, at least 60% of the firms that were trying to fill that craft position said it was difficult to fill. Why? 2/3 of the firms said that available candidates were not qualified to work in the industry. Either they didn't have the right experience and training, or they didn't have the right documentation, or they had some blemish on their employment or personal record that had disqualified them from working on a certain job site. Also, 1/3 of the firms said that potential employees could not pass a drug test. Now, these are questions, these are percentages of the responding firms. We didn't ask firms to tell us how many applicants had these situations, but you can see that these are pretty widespread problems through the industry. A third problem that is probably particular to construction, not unique, but affects construction more than many other businesses, is transportation issues. If you don't have a car, it's hard to get to a construction site that probably isn't along a transit line or where you're having to move around from week to week. So that also keeps potential applicants out. Well, to some extent, construction has always had these issues, and they've compensated, literally, by paying above average wages. We measure this through another series that comes out with the employment report, has the unwieldy name of average hourly earnings for production and non-supervisory employees. In construction, that would cover most of the hourly craft workers and then office workers who aren't supervisors. So I compare that wage rate, those average hourly earnings in construction, to the total private sector for those kinds of workers. And what you see in the graph on the left is that for 20 years in a row, construction paid a premium of 20% or more. It averaged 21.5%. Well, when the pandemic hit, all of a sudden, people cooped up at home, didn't want to go to a grocery store or store, so they were ordering food to prepare at home or prepared meals. They were ordering tons of goods directly from warehouses. What happened with employment? those restaurants and local delivery companies and warehouses that previously started people at minimum wage or even less for tipped restaurant workers. They were vying to get workers in. They were raising wages to 12 or 14 or even $16 an hour, depending what part of the country you were in. So the premium shrank all the way to 15% or below initially. It's come back somewhat in the last year. From September of last year to this September, construction average hourly earnings went up 5.5% for non-supervisory workers. That was a good deal more, 4.3% increase throughout the private sector. But it's only brought the premium back up to about 19%, well below the historic average. And given what's gone on with workforce preferences, so many more jobs can be done, and they're sought to be done on a hybrid or a remote basis with flexible hours, with a chance to leave on short notice, say if the school calls and said, you've got to come pick up your kid. None of those things is possible for on-site construction jobs. So I think the premium is going to have to go even higher than 21.5%. In addition, a lot of construction jobs, more than in the broader private sector, are unionized. And as union contracts that were signed 2 and 3 and 4 years ago with pay raises of 2 or 3 or 4%, as those expire, you can be sure that the new contracts are going to have even higher pay raises. So I think for various reasons, the industry is facing much higher annual wage increases. Well, here's what's happened with wage increases over the last 2 years. The blue line shows that average hourly earnings figure in construction has gone up more than 5% on a year-over-year basis for 2 straight years. I'd have to extend this line all the way over to the North Hall to show you where the last time wages went up that much. It's 1982, 1983. Meanwhile, what's happened to input costs, to materials and services such as design and trucking services? At the beginning of the pandemic, when the economy shut down, prices for many things dropped pretty sharply. But very soon, we saw record prices for lumber, for steel, for copper, much more frequent and steeper increases than we were used to seeing for concrete, for roofing products, for insulation and glass. So for 12 straight months, that input price index went up at 20% or more. The last peak happened after Russia invaded Ukraine, and we saw a huge jump in diesel and steel prices. Fortunately, things settled down pretty rapidly, and we've had decelerating prices. They even declined on a year-over-year basis for several months this year. The latest figures show that they're basically matching year-ago levels. So things at the moment don't look bad for materials. But like the statistician who drowned, let me show you what's happened over the entire period. I forgot I had added this slide just yesterday to the deck. So here, instead of taking the year-over-year change, I'm tracking the cumulative change. And even though those prices, as I said, they've leveled off since early last year, they're still up by a total of 37% since February of 2020. So that's double what most people think of as inflation. The consumer price index has gone up 19%, quite a bit, but nothing like what's happened to producer prices. And then wages, they have not only matched the consumer price index, they're starting to go up faster, and as I said, will go up even more. So where do I see these things headed? Well, I think materials cost, the flatness is over, that we're going to start to see 4 to 6% increases in materials cost in the next year. And wage costs, certainly not coming back below 5, may go up as much as 7%. And these are averages. So for some materials, we've continued to see much higher increases. For instance, cement went up almost 11%. And that flowed through to ready-mix prices, up almost 10%. In fact, there's a producer price index for all concrete products, a weighted average of ready-mix, pre-stress, precast, block, and pipe. And that's gone up for 32 straight months, the most, by far, most frequent price increases in the history of that series. Now, diesel fuel is an example of volatility. Yes, it came down from that record high that was set in June of 2022, but in the last 2 months, we've had major increases. These are measured at the terminal rack or refinery level, so your mileage may vary, as they say, that at the truck stop level, not necessarily the same, but at any rate, 4% increase just from August to September, and that followed a 30% increase from July to August. So while the year-over-year change may look good, recent experience much worse. So subcontractors naturally are passing on those price increases when they can, and their labor cost increases, and maybe something extra if they're able to get that. So while the average for materials and input costs may be flat, it really varies according to the type of business and the type of products you're buying. Let me switch now to what's going on with construction spending by category. Oh, let me show you one other thing about costs and pricing. BLS does ask a large group of contractors each month what they would charge to put up a particular building. Each contractor is asked about the same building as a month ago and a year ago. So this is probably as close as we can come to replicating the normal process of measuring actual sales prices, whether it's for diesel fuel or steel products. And what you see here is the difference between the year-over-year change in the input price minus the year-over-year change in those bid prices. And the last episode ended in June of 2022, and it went on for 19 months. That's when contractors were hemorrhaging profits, at least on their input costs exceeding their bid price increases. It has reversed, but look, that steep decline is over. It's now climbing rapidly back toward the 0 point. So I'm not going to predict what contractors will charge. I certainly don't ask contractors for that. I don't want to get in trouble with the antitrust division. But looking over the history of this chart, I can well understand why contractors wouldn't immediately rush to pass on any materials cost savings that they have a lot of pain to make up for. The peak was 3 times as great as ever before. And the history shows that they can be behind the curve for as long as 2 years. Or things may change month by month, as we see in this period in 2012, 2013. Let me take you through what's happening with spending in different categories. This is a series the Census Bureau puts out on the first business day of each month. And again, they rely on contractors to answer those surveys. So please, if you're getting this form, please do fill it out. It really helps me, I think it helps the industry, and it helps policymakers. They are asking contractors to report on what expense they incurred on a particular project that month, and they keep asking that contractor about the same project until it's finished. You may be familiar with data from Dodge Construction Network or Construct Connect. They're putting out press releases this week that summarize the total value of projects that they deem to have had started in the latest month. And they are privately collecting information. So their database overlaps, but it's not identical to each other or to the census. And because they're reporting the total value of starts, that's a leading indicator. It's suggestive of what's likely to be spent in the coming months. This is a coincident indicator. It goes directly into the gross domestic product report that we'll be seeing for the third quarter next week. Unfortunately, all of these reports suffer from the drawback that they're in current dollars. We don't have a deflator that tells us how much of this 7% increase in total spending was actually new housing units or hospital rooms or lane miles of highway, how much was just price increase. But on first glance, this does look quite positive. All these non-residential segments at least had an increase in current dollars from August of last year to August of this year. Well, on its website, census.gov/construction spending, the Census Bureau provides detail on over 160 non-residential categories. And I've listed the categories as they define them in descending order of August 2023 spending, and within many of the categories in parentheses, subcategories also in descending order. Let's start at the top. Yeah, private residential spending was down 5%, but here's that big difference between single family down 15, multifamily up 25%. That's about to change. This morning, Freddie Mac announced that the 30-year fixed mortgage had risen again to 7.63%. National Association of Realtors said that existing home sales were at a 13-year low. So things sound pretty bad, but I think we're really near the bottom on single-family sales or single-family spending put in place is what this measures. That as other census data shows that single-family starts have risen for 8 straight months, not back to where they were a year ago, but definitely seem to have hit bottom and moved off it. Why? Well, an increasing number of people have enough equity in their houses, thanks to years of rising house prices, that they are willing to buy a new home for cash or put much more down so that that 7.5% mortgage doesn't hurt so much. And then home builders, a high percentage of them, according to a survey by the National Association of Home Builders, high percentage of home builders are offering incentives. They're buying down the interest rate, they're throwing in some attractive amenity or other ways to get people to buy homes. So I think we're past the low point on single family. But multifamily, it's the opposite. As I said, huge drop, 30% or more in starts and permits compared to what's under construction. Rents have flattened or even started falling in some markets. Now, I don't think it's going to be a repeat of the disaster from 2006 to 2011, that people who are priced out of buying a home, many of them are going to be renting, in some cases, new multifamily properties, but definitely a rough adjustment in the next year. Turning to non-residential, you can see that both public and private spending have grown at double-digit rates in the past year. The leading category is manufacturing construction. It jumped from 4th place to 1st over the last year or so with this incredible 66% increase in spending on projects underway. It's led by this computer electric manufacturing plant, typified by the huge fabrication or fabs going up outside of Phoenix and Austin and Columbus, but also multi-billion-dollar projects in places I didn't expect, like upstate New York and Kansas. This week, Micron announced a multi-billion-dollar investment in Boise. So I think this subcategory will remain hot, but there's a lot more. Companies are reshoring in order to get away from those supply chain bottlenecks of 2 and 3 years ago, and also to get away from active or potential conflict zones. And then there's the carrot and stick of the Build America, Buy America Act that requires most of the materials and manufactured goods that go into any federally funded, even partially funded construction project to be U.S. made. And finally, we have new categories of manufacturing for things like battery charging stations, for utility scale battery storage, potentially for carbon capture and storage. So for all these reasons, I think manufacturing will continue to grow at double-digit rates. I can't imagine a compounding of a 66% rate, but 10% or more for next year seems quite possible. Now, highway and street construction also up by a healthy 12%. You might think that was a result of the Infrastructure Investment and Jobs Act that passed almost 2 years ago. But very few contractors whom I talk to say that that's been the case for them. Instead, this reflects the healthy position that state DOTs, local governments, turnpike authorities are in. And so there's already a lot of highway investment coming. And then once that IIJ money comes out, we'll see even more. What's held it up is uncertainty over the application of those Build America, Buy America requirements, apprenticeship rules, and the usual challenges getting permitting and siting and court challenges out of the way. Commercial is a term that gets used in a lot of different ways. For census, it means warehouse, multiple categories of retail, and farm construction. Well, a couple of years ago, warehouse was by far the hottest market. It was growing 30% or more as so many goods were flowing through warehouses or being stockpiled there. And now, though, many retailers say, well, we can get it just in time. Again, we don't need to store it just in case. And consumer preferences have moved away from goods, particularly big durable goods, and spending instead on experiences like going to the Sphere in Las Vegas, or a Taylor Swift concert, or a movie if you couldn't buy tickets for the concert. So I think that retail is in for a rough time. Yes, there's always going to be churn, new tenants replacing old ones as firms like Rite Aid or Bed Bath & Beyond shut down, but new stores, not so much, and certainly not shopping centers. So warehouse, I think, will decline. Retail will be flat at best. Power construction includes every type of power generation, transmission, local distribution, but then also census puts in the spending around oil and gas wells and pipelines. As long as the Biden administration is in office, I don't expect to see growth on the oil and gas side, maybe not for much longer than that even. But the Inflation Reduction Act that passed in August of last year has incredibly rich tax credits for lots of kinds of alternative power and for new industries like carbon capture and storage. Will those happen? Maybe. The tax credits still need to have tighter or more specific regulations in many cases. So at the moment, investors have been keeping their money on the sidelines by and large, but I think that there will be a large wave of investment in alternative power. And we are starting to see some examples, like some major transmission lines here in the West and the beginnings of offshore wind, certain areas with large solar or wind fields, new utility scale battery storage. Education looks positive for both K through 12 and the higher education. But I think things are going to shift. For years, we've seen the number of high school graduates diminishing as the baby bust works its way through the grades. Adults who formerly went back to college or university for a new degree or certificate can change jobs now without doing that. And foreign students who were typically full pay and may have made the difference between a college ending the year in the red or the black, they haven't come back in the same numbers as before. So for multiple reasons, I think higher ed will have less need for new dorms and classrooms and less ability to pay for it. So I think that growth rate is going to taper off or even turn negative. But with K through 12 schools, most of them are funded by public school districts, either through bonds or current spending that relies to some degree on property tax receipts. The realtors reported this morning that house prices have continued to rise for existing homes, and new house prices also. And more properties, both residential and commercial, are being added to tax rolls in many school districts. So school districts do have more money to spend on new schools and on reconstruction. So that piece of education spending should stay positive. Now, office looks surprisingly strong. There are two jokers hidden in this deck. First, all of these non-residential categories include remodeling, renovation, even repurposing for some office buildings. But the bigger problem is that it includes data centers. It drives me crazy that we still don't get data on data centers. If we did, I'm sure we would see enormous growth. It's happening all over the country, right here in Las Vegas, in Phoenix, in Salt Lake City, certainly in my home area, Northern Virginia, but other parts of Virginia. Just announcement week after week about new, more expensive and more dense data centers. So if you took out the data centers and the remodeling and repurposing, new office construction would be negative, and I think will only get more so as more office leases expire, companies subletting or moving to smaller space, not going to big fancy new spaces that stay vacant for most of the week. Transportation covers various modes and both public and private spending.
And again, through the IIJA, we expect to see a lot more money flowing into airports, into Amtrak, into transit projects. So I think this will remain a positive next year. And then healthcare, you can see hospital spending has rebounded from the big decline at the beginning of the pandemic when hospitals were losing money and concentrating entirely on COVID care. Conversely, special care facilities, pop-up clinics that opened in the first year or two of the pandemic, now that activity is gone, so there's been a big negative. But I think the trend over time will be for more care to be delivered outside of a hospital setting with specialized diagnostic or treatment or long-term care facilities, whether it's for so-called long-haul COVID or for other chronic diseases, more population aging and needing treatment outside of a hospital setting. So my betting is that over the coming years, more of the healthcare dollars or more of the increase will be showing up on medical buildings and special care facilities. Hospitals, yes, the university, teaching hospitals, big medical centers, they're always doing construction. But on net, the hospital sector, the count of hospitals is shrinking as community and local hospitals close. Well, to sum up then, I remain optimistic about the economy. I confess to being a serial optimist. A year ago, I was fairly lonely in saying, no, we're not about to have a recession, or certainly not in one yet. Instead, I talked about touch and go, in both the sense that things could go either way and the pilot sense that the economy would touch zero but then take off again right away. Well, in fact, it never had that landing that was so much talked about, either soft or hard. We had this huge increase in jobs last month. We had very positive reports for retail sales for both September and upward revisions for July and August. Businesses, in spite of bankruptcy showing up at companies as diverse as Bed Bath & Beyond or Yellow or today Convoy, if you were using that for scheduling loads, it sounds like they're shutting down. But by and large, businesses are still increasing. Many showing profits, certainly investing more, and governments at all levels, federal, state, and local, putting lots of money into different kinds of spending. So I think that we will continue to see job growth. We're seeing wages go up faster than inflation. Remember that total wage increase, hourly wage increase for production workers, 4.3%, with inflation now in the threes at the consumer price level. So things are looking healthier in terms of consumer spending power and other parts of the economy. Certainly there are plenty of risks, as we've seen in the last 2 weeks with the attack on Israel, the shutdown of operations in the U.S. House of Representatives threatening to lead to another government shutdown. That may not be a problem for some of you, but it certainly hits a lot of people in the paycheck. It does mean that some construction projects can't go ahead. So yes, there are risks, but I think overall the balance of risks is for further growth. Now, for construction, we're certainly seeing changes. I talked about the decline we've already seen in single-family home building and how that may start to climb, but I admit there's risk there that the Fed is not going to be lowering rates. This morning, Chair Powell said he expects to see a long-term pause in the Fed raising rates, but while I'm optimistic about growth, I'm not optimistic about inflation. I think getting from 3-something down to that 2% goal, that's going to be very hard. So I think rates are going to be stuck where they are, may even creep a little bit higher in the next year. And so that holds down home buying, and it's a big negative for any developer finance category because developers have to pay both financing costs and construction costs. And as those rise, they have to cover them with higher rents. Well, we're seeing, in fact, flattening or declining rents in some markets for multifamily, for warehouse, for certainly office looking really bad, and lodging possibly, retail mostly, yes. So those all look negative. How can I be optimistic about construction? Such strong growth still continuing in data centers and manufacturing and coming on even stronger than we are now in power and infrastructure categories. The big problem now and for years to come is labor availability. As I said, For construction, it may have become an even bigger problem than it has been because other jobs can be done remotely or at a hybrid basis and in more comfort than the 100-degree weather that we're having out here. Furthermore, as population growth shows, and I'll close in a minute with a map of where that's been happening, more people retiring, fewer people coming into the workforce, all industries will be competing for those replacement workers, and construction among them and at a disadvantage. Furthermore, slower growth means eventually slower growth in demand for housing, subdivisions, with it the streets and underground utilities, the schools and public safety buildings that go with new subdivisions. Big changes in how goods are delivered and what people want. And so warehouses, saw a report today that Amazon is investing in another round of advanced robotics inside at warehouses. That allows them to go still higher and more dense, fewer workers, and they're also experimenting with delivering pharmaceuticals by drone. If this catches on, we'll see more deliveries both to the warehouse and from the warehouse to the customer by drone or robots or autonomous vehicles. And that changes the footprint of a warehouse, perhaps fewer employees and less employee parking, less space for cafeterias, and fewer trucks coming to the warehouse or moving away from it, less truck parking, fewer truck bays. Healthcare and energy, also big changes coming. For me, the biggest question is, what's going to happen with the office market? Are we eventually going to be coming back to large office buildings, dispersed WeWork type co-working spaces, office parks? We'll have to see. And then not clear, where is population going to settle? We can't tell that. We can tell what's happened in the past. Unfortunately, this map is a year out of date. The Census Bureau provides annual estimates of state population change, but not until late December. At any rate, what we saw a year ago was that U.S. population grew by 0.38%. That was more than double the growth in the first year of the pandemic, but only about half as fast as in the previous decade. And we had a record number of states in deep red, meaning they lost population, 18 of them. Florida became the fastest growing state in the country for the first time since 1957. It nosed out Idaho, which had been in the top spot for 5 years in a row. But in general, the growth was concentrated in 3 areas: the Southeast, Texas, and the Intermountain West. And while I think the shades will change somewhat, the patterns are going to stick for quite a few years. People are leaving the Northeast and the Midwest for the Southeast and for Texas. People are leaving the West Coast for states that aren't so high cost for housing, for high commute times, and difficulty doing business. So that has meant these states in the Intermountain West. And then people are leaving from all over the country for Texas. So I did this map a year or so ago for a bunch of state DOTs. The guy from Montana, when he saw how high their growth had been, said, "Montana's full." Well, it's still by far the lowest density state among the lower 48. But I think there is a bit of truth in that. People who have moved to Montana may find that it's too empty compared to what they're used to. So I do think that growth in some of these really low density states like Montana and Maine will revert to their historic patterns. But by and large, I think what you're seeing here is going to remain true. So that's my story. I'm sticking to it till I get new data. When I do, I'll put it in the Data Digest. That's my weekly summary of economic news relevant to construction. Be glad to add any of you to the email list. Just email me at ken.simonson@agc.org, and I'll send along the latest version of these slides. Tomorrow I'll update that state employment map, for instance. And I encourage you to go to agc.org, look at some of the many resources we have there, or contact me if there's other information you'd like to have. And I will stick around if you want to get my business card, or if you're hesitant to ask an economist a question in front of a room full of your peers. But go ahead now if you're bold enough to ask in front of the public. But thank you very much for your attention. I appreciate it. Yes, sir.
So how does, I mean, immigration has been a big issue. It's been a big issue. It's on the headlines right now, but it's been a big issue for several years. How does that come into play with the construction employment?
Yeah, there are several aspects for how immigration comes into play with construction. First of all, construction has always used foreign-born workers to a greater extent than most industries. And when we saw sudden decline in immigration, partly from the pandemic, that definitely had an impact on adding to the difficulty finding workers. Now there has been, again, a surge of people trying to cross the southern border into the U.S. They're not necessarily people with construction skills or interest in going into construction, and also they're generally not able to get legal work papers, at least for several years. So while there may be these surges in immigration, they're not necessarily helpful at this point to construction. Now, AGC puts out press releases each month when these different data points come out, and we are regularly calling on the administration and Congress to improve the employer-based immigration system for companies that can document an inability to fill jobs at the local with domestic U.S. Workers. So far, and I'm really pessimistic about our chances in the next year given the disarray in the House, so far we have not been able to get any progress. We really need legislation. Whether the administration can do something on its own remains to be seen. But at any rate, to me, that's the solution to this declining size of eligible or of people interested in the U.S. and working in construction. We really need to be able to bring in foreign-born workers, but Congress has been stuck over this for decades now. The other approach, of course, to getting more workers is to get more students interested in construction as a career. And there I'm seeing limited examples of success. Certainly, AGC's 89 chapters and many of our members are engaging directly with school district, community colleges, workforce agencies to get the message out that construction, you get to play with cool tools like drones and 3D printers and robotics. You can show your friends and family that you've built iconic features like the monorail or the sphere, and you can also move from starting at the lowest level up to running a company, as so many people do. But it's still a challenge to get people to look at construction. So I think immigration has to be part of the answer, but it's going to take a long time.
Great talk, thanks. Ken, you said how does the inverted yield curves play on that optimism?
Sorry, I missed the last part of that. There was some noise.
How do the inverted yield curves play on your optimism for the economy?
Well, I would say I'm optimistic on most fronts. I think the supply chain is generally going to be better, although certainly has not improved from what I hear in terms of getting those electronic components, whether it's switchgear or transformers. This morning I heard that fiber is a problem for a company that's installing traffic control devices, and I think that we're going to have issues pop up now and then. Let me talk about cement for a minute. That a year ago this month, the Portland Cement Association did a survey, and all 48 contiguous states, they said there were, quote, tight supplies or mixed reports. I haven't heard any mixed reports. It's all good in terms of being able to get ready mix in the quantities and the timing you want. But I also look at the future supply. I don't see people willing to have a new cement plant in their market, and certainly see growing demand from infrastructure and power and immense manufacturing plants. So I think we will see regional or product-specific problems cropping up. In terms of the metal market, I think that there looks to be a lot of capacity, will be for quite some time. I'm concerned about tariffs or non-tariff barriers that keep us from getting ample supplies of certain materials. And I certainly see a lot of competition happening between construction and, say, EV and battery manufacturing, or maybe semiconductors for some things. So it's going to remain a challenging market. We're not going to have the relatively smooth, slow growth that we had for so much of the last decade. But at least overall, things should be positive, and cost increases rising more moderately, fewer supply chain problems. Of course, nobody anticipated, or at least I didn't, a pandemic, a giant freeze in Texas in February 2021 that cut off the supply of plastics, Russia's invasion of Ukraine, Hamas's attack on Israel, blockage of the Suez Canal. We've seen that all kinds of things can crop up and cause unexpected problems, but we've also seen that the U.S. economy remains extremely resilient and, in general, able to get past those things.
Ken, first of all, thank you for being so articulate and clear and everything. I love your presentation. I'm a metal roofing contractor from Pittsburgh, Pennsylvania, and what I found, just for instance, copper roofing. I do a lot of copper flashings and slate and stuff, and I found my suppliers have been really across the board on prices. For instance, a job I'm bidding right now, called 3 suppliers. They range in price from $950 a roll to $700 a roll for a 100-pound roll of copper. So they aren't keeping up, or they raised their prices, and the price of the copper on the New York Stock Exchange is like $7 a pound, and that's what so you really got to sharpen your pencil. I've never had to make so many phone calls, for a single job. Can you speak to that issue?
Yeah, we've seen pretty sudden and rather large moves in several types of commodities prices. So for several months, copper futures were hanging in the $3.70, $3.80 a pound range. All of a sudden, they've come down to $3.50 to $3.60. That's a big move, 5% in just a few weeks. And so it doesn't surprise me to hear that you're hearing different prices depending on when people locked in their own supplies and how long they think they can hang on to that margin. But right now, while I think the U.S. economy is going to grow, there's a lot of doubt that China is really going to step up its growth, and that has a huge impact on copper and on other things. Copper also is one of many materials important for EV batteries, and while EV production has been rising very dramatically, there's been quite a slowdown in the growth of sales. In fact, just within the last month, both GM and Ford announced that they were going to delay or put a pause on building EV and battery plants in Michigan. Other plants in Tennessee, Kentucky, Georgia, those are going ahead at the moment, but we've also seen bankruptcies just in the last month from a couple of would-be EV producers. So lots of things affect the materials that you buy or the products that you're selling, way beyond the historic customer base that you've had. So it really is an interconnected economy, and one that's subject to sudden shocks as well as changes in preferences and bad guesses about how much demand there would be. All right, well, I'll let you go enjoy the rest of the exhibit, but please stop by and get my card. Let me know what's happening in your part of the market if you're interested. Thank you again.